Hello and welcome to this episode of Nucleus Wealth Empower. Today we're going to speak to author Michael Kemp about his new book, The Ulysses Contract, How to Never Worry About the Share Market Again, a guide for share market investors. Michael has worked as a periodontist as well as having an extended career in finance. More recently, from 2011 to 2020, he worked as the chief investment analyst for Scott Pape's Barefoot Blueprint newsletter. To Michael, finance has always been a passion, never a job. And as well as managing his own portfolio, he spent a lifetime reading, researching, writing, and speaking about share investment. The Ulysses Contract is his third book. Welcome to the show, Michael.
Hi there, Shelley. Thank you for having me on.
Pleasure. I'm Shelley George, Chief Operating Officer at Nucleus Wealth, and I'm coming to you today from the lands of the Gadigal people of the Eora Nation. We love bringing you content at Nucleus Wealth, and you can help us continue to do so by subscribing, liking, and clicking the YouTube bell to be notified when there's more. A really important note that I want you to please keep in mind is that any advice in this show is general in nature and doesn't necessarily relate to your personal circumstances. But if you would like to discuss anything, you can get in touch with us on 1300 623 863 or contact@nucleuswealth.com. So, Michael, could you start off by giving listeners an overview of the Ulysses Contract and what to expect from it, please?
Sure. It's a book. It's a book that I saw the concept or the idea or the statement of the Ulysses Contract a few years ago, and I thought that's going to be a great title for a book because Ulysses, as you know, or probably don't know, I don't know, is written about in Homer's poem, and he's sailing. He's the king of Ithaca. He's sailing home after the Trojan Wars, and he's sailing past an island inhabited by sweet singing sirens who seduce seafarers onto the rocks. So he asks his crew to put wax in their ears, and he wants to hear the sirens himself, so he asks them to tie him to the mast. So what a Ulysses Contract effectively is, it's something you put in place now to stop you doing something stupid later on. And I thought it was an appropriate title for investors because investment is a journey, and we are seduced by seductive financial sirens, and there are many of them that I'll list in my book. So it's for investors who possibly, and we're all human beings, want to avoid seduction into financial traps. Basically, the reason I've written the book is I'm a great believer in some advice that was advised a couple of 100 years ago, that losing an illusion makes you wiser than finding a truth. And I think there's a lot of illusions we have as investors, a lot of things we believe that we shouldn't necessarily believe. And if we can get rid of those things that don't work in investing and focus on the things that do, and avoid the seductive sirens, the things that may tempt us into doing stupid things. So I list them. And at the end of the book, I actually talk about a contract, a Ulysses contract that you can put in place that will tie you to the mast and help you avoid financial temptation to do silly things when you're investing. So that's basically what the book's about.
Yeah, that's great. I really liked that concept that you had of the illusion and trying to cast that away. I certainly worked in the finance sector for over 15 years now, and have got this feeling that the sector certainly benefits from making finance seem more complicated than it needs to be, and that it's actually really possible to reduce a lot of things to simple concepts, which I think you've done really well in the book.
Well, that statement, Shelley, that I mentioned was from a German called Karl Ludwig Born. He wrote that statement, losing an illusion makes you wiser than finding a truth. He wasn't talking about finance, but I thought it was so appropriate to finance.
Yeah, I agree. It is very appropriate, and that's one of the things I love in the book is that you reach so far outside of the realm of finance to bring in the philosophical, philosoph- philosophical,
Philosophical. Look,
philosophical. Thank you, idea.
I think it's so appropriate. I think we can become so focused on mathematics and accounting and finance and the markets that we lose sight that investing actually incorporates all disciplines. It incorporates, philosophy. It incorporates history. I think there's barely a human endeavor or a human area of knowledge that you can't bring forth to involve in investing. And I think that's what we need to do as investors. Um, so
Definitely.
that's what I try and do in my books anyway. And you'll probably notice that a lot of the discussion about finance is also fairly philosophical because I think we get too wrapped up in the importance of money. And I think it's a much, much broader topic than just making more of it.
That's actually brings me to the next question that I wanted to ask you, which is, um, I think so often when we're talking about investing, we're really thinking about just the dollars and the cents that you can get at the end of it.
Hmm.
But as you point out, that that's just a means to an end. The dollars and the cents in and of themselves aren't going to make you happy. It's really what you can use them for. And also that it's life can be so much greater than just spending. Um, and so what I wanted to ask was uh, how did you kind of come to this, or what was your journey like where you came to this conclusion? Because it's not an idea that I really feel I have been exposed to a lot in my career or at school or through the media. So I was really interested in it.
I haven't always felt this way, Shelley. I'm a product of Australia, which is a very rich society. Um, and we in society tend to judge ourselves by what's going on around us. Uh, so we don't judge ourselves as rich or poor by looking at the entire world. I mean, there's billions of people in the world, and we should judge ourselves as rich or poor by comparing ourselves to the rest of the world, but we don't. Humans don't do that. They compare themselves to the person next door or the person down the street or what they're reading um, in the media. So Australians judge themselves against other Australians. And the thing they fail to forget, or fail to remember, I should say, the thing they forget is that we're one of the wealthiest, if not the wealthiest nation in the world, financially, per capita basis. And I'm comparing it to America and Switzerland. I mean,
Mm,
we are a very, very wealthy nation. And there's only 26 million of us, and we're more worried about, how new our car is or how big our house is. And I woke up to this at a fairly youngish age. I was a young adult, but by relative terms to what I am now, anyway. So I was part of that. You've got to have this and you've got to have that, and I don't think that way anymore at all. I think one of the things that was a turning point for me when I was 43, really, my brother died at 48, and I started reading a lot of
sorry to hear
philosophy,
that. Yep.
a lot of philosophy, and I gained a perspective. And my first book is even more into this, which
What's
I
the
wrote,
title of that one?
Creating Real Wealth, and the emphasis is on the word real. Okay, real
Yeah.
wealth. It's a very philosophical look at money. I mean, you can tell people these things, but it's not what they feel. I mean, you can say this stuff all day long, and it doesn't change the people. It changes the fact that when people stop listening to it, they go and act differently. But it's a truism. It's a truism that you only need a certain amount of money. And once you are healthy and you've got food on the table and you're not stressed about the mortgage and you're not stressed about car repayments, you're not stressed about money, but as long as you're comfortable in life, you can be just as happy on 80 grand a year as you can on 800 grand a year. The rest of it's like pouring water into a bucket that's full. It just overflows. And I worked this out a long time ago. So I have far more money than I need, and I use it to create well-being not only in myself but people around me who I love. And it's a personal thing. I don't really want to talk too much about it, but I do help people who mean a lot to me.
Yeah.
And I get enormous satisfaction out of that because I don't need all the money I have.
Thank you. So, one of the other things I was interested in when reading the book and also about yourself is your career journey.
Yeah.
That's obviously been quite broad. Um, and
Messy.
so, really interested in how you came to make a transition from dentistry, is that right?
Yeah.
To investing. And whether or not that was at a similar time as when you were sort of starting to read some of this philosophy.
Time frame's a bit messy, but no, it was before that. At school, I was doing very, very well at sciences, and I don't know what life is like at school now. We're talking about the 1970s, and you were told that if you do well at sciences, you become a doctor or a whatever. I didn't want to be a doctor, so I chose dentistry instead. And it appealed to me because I could work for myself. Very easy to run your own business, and I had a business aptitude. Problem was, I discovered that I didn't like general dentistry. So I did a master's in business in an attempt to explore what I might like to do, and discovered I like corporate finance. So while I was still in my 20s, I went for a search for a job in corporate finance. And then I switched back to specialist dentistry, periodontics later on for family reasons. When I was in corporate finance, I was getting pushed and shoved all over the place and off to London, off to Sydney, off to this. I never saw my kids growing up. So I got back into a specialist arm of dentistry. But I, I didn't use the money for spending on, consumption. I saved most of the money and I retired from that quite young and got a job in finance again. I was working with Scott Pape, which I thoroughly enjoyed.
Okay, great. All right. Thank you for sharing your journey with us. Um,
The message there for people, and it's not to feel committed that you have reached a career and just because you don't like it, you think of these sunk costs of all these years that you've studied to get there. I mean, I studied hard to become a dentist, but you look forward, not back. And I didn't say, oh, I have to stay a dentist because I've spent so much money, so much time and effort being. Don't destroy your life going forward because of what you've done in the past. And if you want to pursue something, do it. You'll be much, much happier.
that's a great lesson. Thank you. Yeah. Um, I think, well, on a personal level, it's certainly my career has evolved with a curiosity and not a clear idea of where I want to go. And so, hearing about how you've kind of discovered, um, what is you want your life to look like, and as part of that, your career has it's been really insightful and
You can never
helpful.
fail if you're pursuing what you enjoy. And I often say that if you're unsure what to do, I think some of your natural talents start very early in life. Some of the thing, your aptitudes, and you may forget what you were doing when you were 6 or 7. So ask your parents. I mean, my mother knew better. When I told her I was thinking of giving up dentistry, she said, "Oh, now you can become a stockbroker." I always thought you were going to be a stockbroker, Michael. So, you know, when I was 6, I wanted to be a bank manager, apparently. So, finance, finance was something I wanted to do from a young age, but I just didn't know it. I should have listened to what I was being told.
That's great advice. Yeah, really great advice.
Show me the boy at age 7, and I show you the man. Is the old saying, isn't it? And it applies equally to women, of course.
Yeah,
It's
obviously.
not a sexist comment. Have you seen that series? What is it? That Granada series from the early '60s, and it kept following kids through time.
I
Um,
haven't seen that. It sounds fantastic.
well, they interviewed them at age 7, and then they're 14, 21, 28. But they're asking them at age 7. It's a longitudinal study. The English series, Granada TV. It's fascinating to hear them being interviewed at age 7 about what they want to do when they're older, and most of them ended up doing what they said they wanted to do when they were 7. So
That I think that could change a lot of people's lives, really, just
mm,
being aware of that.
yeah,
I think I've heard of the study, but I haven't seen the show. I'll have to find
it's
it.
great. Yeah,
All right, so diving a little bit more into the book, as you said, you talk about some of the sirens that are out there when it comes to investing that can really seduce people off what might be, an optimal path for them. And there were two that I really wanted to chat to you in a bit more detail
Sure.
about. Um, the first one is in the chapter "Believing What Isn't So." You talk about the Dunning-Kruger effect. So I guess I just wanted to start with, can you give us an explanation of what the Dunning-Kruger effect is?
It's based on research done by those two men that we believe we are better at things than we really are. And we can be quite poor at something and believe that we're better than average. I mean, there's that old Scandinavian study, Swedish study, that 90% of people believe they're better drivers than average. And I always say we should get the other 10% off the road. but we all do. We all do it. And I think it's rife in investing. Most people think that they are better investors than what they really are, and what they should realize is that even people who are have been in investing for many years, they're professionals, even they find it harder or difficult to be above average. So Dunning-Kruger effect is overstating and truly believing that we are better than we are. I think it gets back to this thing about illusions, or delusions in this case. We're deluded that we're better than we are, and it's a very dangerous thing in investing. We are probably average, and many people below average, really.
Yeah, so it certainly sounds like it reading your book. And as you point to in the book, there's a lot of evidence to back that up. Um,
I talk about lemon juice investors too. You remember that. That's my concept, not others. Based on a guy called MacArthur Wheeler, who was a bank robber. Do you remember that story in
yeah,
the
that was
book?
great.
I better tell people about it
Let's,
now that
yeah,
I've
do it.
introduced it. MacArthur Wheeler. This is a true story. He was a bank robber, and it was back in the days when to rob a bank you actually ran in with a mask and a gun, not like today. And this was in 1995. And he and another fella ran into this bank, actually two banks in Pittsburgh, but they didn't bother wearing masks. That's true. Um, Even though there were security cameras, they didn't bother wearing masks because MacArthur Wheeler believed that if you rubbed lemon juice on your face, he'd heard that lemon juice makes invisible ink, that the cameras wouldn't pick up his face. I mean, we laugh because it sounds so silly, but I talk about lemon juice investors because we're all capable of carrying delusions and illusions about our capabilities, and more importantly, what works and what doesn't work. And I talk about that we're all lemon juice investors. I mean, there's another one, basically, and I didn't write about this in my book. It's about a guy who jumped off the Eiffel Tower in 1912. His name was Franz Reichelt, and he had made a suit, a flying suit. Right, it wasn't a parachute. It wasn't like one of those sort of gliding possum suits that they wear today. Um, it actually tested this suit, this flying suit, on dummies and thrown them off the top of tall buildings, and they just crashed to the pavement before. But for some reason, this day he climbed up the Eiffel Tower and believed the suit was going to work on this day. Of course, he just plunged to the ground. A bit
And
like lemon
died.
juice investors.
That's an incredible story. I've heard that one before.
So we carry these beliefs that things work when they don't, and um, it's so true of investing. I mean, investment great Ben Graham, who most of you should know, he wrote that book, The Intelligent Investor, in 1949, and he was Warren Buffett's teacher at Columbia University. And in The Intelligent Investor, he wrote the investor's chief problem, and even his worst enemy is likely to be himself. So I talk about a number of sirens in my book. I think about 11 of them from memory, and many of them are actually derived from our brain, from ourselves. We don't need to hear them. They're internal sirens.
That was actually my next question on this. But before I do, I jump into that question. Um, I guess when you retold that lemon juice story, what struck me and was that often I talked about this with Nucleus Wealth Chief Investment Officer Damien. Um, Very often in, say, a news story or something like, or even an opinion piece, there's a kernel of truth to it. And so, like, one of the big challenges that I think it was McCarthy faced was that um, he had read or heard that lemon juice was an invisible ink that you could use, and I mean, I think I've heard similar stories. How true or it is or it isn't sort of isn't my point. It's that he's taken what could be a kernel of truth and
We
extrapolated
latch
something
onto things.
far beyond that. Um,
Yes,
so I
we
thought
all
that was
do it.
interesting.
I mean, we
Absolutely.
we laugh about that story because it sounds so ludicrous, and we would never do it ourselves. But we all do things like that are perhaps more subtle and not as obvious. And that's my book tries to identify many of them in the investing arena.
Absolutely. And what I enjoyed about it was it talks about the reasons why we do that. So it looks, you look back historically at, where humans began, and the circumstances we lived in then, and the behaviors we needed to survive that, and
That's
to evolve, and how we keep doing them. So I guess I was interested with respect to the Dunning-Kruger effect. What was it that you found that was the reason why we tend to have this, I guess, overconfidence maybe in our own abilities?
Yeah, I think as a race, we have shown great advancement over the thousands and thousands and thousands of years, and a lot of this is built on optimism. I mean, it's because we need to be optimistic about ourselves, our lives. We have to be optimistic. It's innate. And I think I say in the book that if we didn't have the Dunning-Kruger effect, if we weren't optimistic, if we were pessimistic about our own capabilities, what would we have achieved? Mankind and womankind and humankind is based on optimism and people pioneering. Some of the greatest optimists in the world um, have built ideas that other people have said are crazy. So it's a survival instinct.
Yeah, that's really true. And I guess to answer your question, what would we have achieved? Probably nothing. We wouldn't have left the cave to try and find food, maybe.
Yeah.
So,
Yep.
yeah.
Pretty
Okay.
much.
And what are your thoughts on how important this specific siren is to investors, and being aware of it, or kind of controlling for it?
Well, we're talking about money here, aren't we? So if you think you're a better investor than you are and you're going to use tools that don't work and into the fray, you're going to lose money. I mean, just don't do anything stupid. I think market timing is a perfect example of this. People genuinely believe that they can market time, and they can really get undone badly.
Absolutely. I certainly have seen that a lot in my conversations with people around my career, in and out of the industry. And I guess that was the next one sign that I wanted to go to, was this idea of market timing. I really liked the way that you clarified in the book between what it is and it isn't. So I wonder if you'd be willing to share that with the listeners.
Yeah, look, market timing isn't predictive. People think they can predict and they can't. And I think one of the greatest problems is the way forecasts are delivered. They're delivered as a narrative. And I talk about this in the book. History is a narrative and it happened, it's factual.
Mhm.
But when you hear forecasters talk about the future, they deliver it in the same way as a narrative and it becomes highly believable. Now, people can't stand a void of knowledge. Human beings can't stand a void of knowledge. They're terrified by it. Alfred Coles said almost 100 years ago that the reason we believe this is because an unknown future can be terrifying, and humans are terrified by not knowing. So if they hear a narrative about the past, and that's factual, and they hear a narrative delivered about the future, even though it's pure speculation, they believe it. The other thing human beings do, we do, I shouldn't, I should just say we do, is after the event, after something has happened, we overstate our capacity to have known that that was going to happen. Oh yeah, I knew all about the 1987 crash. No, you didn't. You just think you did, you know. And I talk about what I am capable of with market timing, and I talk about 4 crashes in my life that I basically didn't know that were coming. I didn't believe in .com. I thought that was going to end up in tears. I didn't know when, but it was just so ridiculous. But the thing I feel comfortable with, Shelley, is in the wake of a crash, and not everyone does. When a market has crashed, a lot of people become extremely fearful. And I even hear it from professionals, and I hear it from professional commentators. I'm not going to name some, but some particularly in the wake of crashes. Well-known commentators can say, "Don't enter the market; it's dangerous." I don't know what it is in me, but I always get excited in the wake of a crash. I remember in the wake of the GFC in February, March 2009, how excited I was, how cheap bank stocks were. I knew the Australian banks were okay, and the PEs and the dividend yields they were selling on was absolutely phenomenal. So, but not everyone feels that way. But this is not this is market timing with me after the event. The market has already crashed. I didn't know it was going to happen.
Sure. Yep.
I didn't know it was going to happen, but so it's an opportunistic adventure for me, not a knowledge that it was going to happen.
Yeah.
As I
Okay.
said, I've been investing now for 4 or 5 decades. The only crash that I felt comfortable with foresight was .com, because it was just so absolutely crazy. And if you don't believe me, I'll give you the name of some of my friends, because as I say in the book, I was squawking like a chicken. This is going to
That's right.
crash. This is going to crash. I never owned any .com stocks. I didn't believe in them. I thought they were unrealistically priced.
Um, I as I was reading about your comments on the .com, it turned my mind to the present day and the excitement that we have around artificial intelligence in some of the investing circles. And I haven't actually looked at the PEs and compare them to .com, but I don't know if you're willing to comment at all on
Yeah,
that.
I will. Look, artificial intelligence is great. Well, I don't mean that as a sense it's going to be great for mankind. We haven't decided whether it's going to be great for mankind yet. But there are AI stocks that will be a great investment. I don't know which ones.
Mm,
And the same with .com. I mean, Amazon came out of .com. There are great companies there, but not all of them are going to survive, and not all of them are going to be great investments. And this is what happens: is when people get excited about a new technology, they price everything as if it's a winner. There will be a few winners. We just don't know which ones. And I compared in my book .com with the South Sea bubble of 1720 in England. Um, Now it's called the South Sea bubble, but the South Sea Company wasn't the only company in that bubble. There was many companies that were just ridiculous, and they failed. South Sea Company actually was a successful company and lasted for a long time after 1720. It was a great company. It was overpriced in 1720. But there were a lot of bubble companies, and I think that happened in .com. And if you want to talk about AI, there will be a lot of losers. Just don't ask me which ones. I mean, you go back to .com, and Amazon looked like a lot of the other .com stocks. But look what
yeah.
it's become. Look what it's become.
You touched on an important point there as well, is so it's not just choosing the right one, it's valuation does matter, in the sense
Yes.
that Damien's done some episodes on this recently, about values in the tech sector, semiconductors, and I think one of the ones you compare them to is Cisco, which is, it's still going, and from memory, it's doing pretty well. But if you look at the multiples or the PEs that were paid around the time of the dot-com, it hasn't necessarily been able to grow from there. So I think that's something you touch on in the book as
I
well, the
mean,
importance of valuation.
a great point to make here is that what happens when there is a tech craze, and tech crazes have been going on for centuries. The stock market started in 1602. In terms of stocks, tech crazes have been going on for 400 years. There's nothing new about tech, and I'll make that point in my book too. Um, but the issue is that the problem is when there's a tech craze, everyone jumps in. Every mum and dad investors, people who have never invested before, people that don't know what they're doing. And they get very excited for a while because the prices of all the stocks that are in the craze are going up and they think they're doing wonderfully. The point I want to make is that the only legitimate investors in this AI are people who truly understand AI. Not the mums and dads, not the taxi drivers, not everybody. Gets down to the Dunning-Kruger effect again, plus a bit of greed thrown in. It's really only people who understand the tech sector who are legitimate investors. And even them, they're going to pick some losers.
As you
So,
say in the book, there's a couple of examples of business owners that they haven't even known how big that they could be.
correct.
So
Absolutely correct.
yeah,
I mean, Apple's the perfect one, isn't it? Steve Jobs
exactly.
sold his share. Um, Steve Wozniak sold his shares, and they were the two founders. There was a third founder who sold out within weeks or months of the company even starting.
Mhm.
So that's a perfect example.
Yeah. Um, which leads me to one of the questions I wanted to ask you, which is one of the big conclusions you come to is how beneficial passive investing can be for really the majority of investors.
Absolutely.
Um, and so, one of the questions I want to ask you about this is, I guess, like this concept of price discovery, that, I guess we've seen sort of in efficient market hypothesis and all the varying states of efficiency that markets see. And this idea that active investment helps for the market to kind of determine what might be a reasonable price for stocks at that point in time. And so, I guess the question is there a place for active investors? How big or small do you think that might be?
I think there is a place for active investors. I think the skills that an active investor needs to bring to be successful are changing.
Mhm.
I mean, here's a perfect example. You look at Ben Graham. He wrote his first famous book, because he wrote two, Security Analysis in 1934. The Intelligent Investor came many years later, but security analysis outlines a way that you can look for stocks that will perform well. But this book's nearly 100 years old. And I think people are kidding themselves if they can read security analysis today and use what it is telling you to beat the market. And Ben Graham said this himself. Ben Graham died in 1976. And in an interview before he died, he basically said that what he wrote in security analysis will make you probably safe investor, but it is a far cry from what you need to outperform in terms of beat the market. And if it's coming from him, and it's a long time since he made those statements, think how many people, more value investors there are in the world than when Warren Buffett started
Yeah.
at the age of 26 in 1956. I mean, the first 13 years of his investment career, after he left Columbia University and worked for himself, his average geometric return was 30% per annum. It's huge.
Mm, yep.
But he said he didn't have much competition back then. This is before value investing became so popular. And so what's happened is it is become harder and harder and harder to beat the market using the skills that were taught uh, to active investors by Ben Graham. Now, that's not to say you can't beat the market, but what is required has changed, and you have to develop your own unique edge to be able to beat the market. And one of the big pushbacks I get, Shelley, and I got a bit of pushback in this book, is you talk about, and I got to say, I'm getting on my soapbox here. I got to say,
For it, please.
it tends to be, and I can say this because I'm a man, it tends to be from young males. Hey, mate, you didn't tell me how to beat the market. I think women are better investors. They're more realistic.
After reading your book, that's what they say to you.
mate, you didn't tell us how to beat the market. It was all negative, negative, negative. Young sort of testosterone filled males, they want to get 30, 40, 50, 60, 70% returns. And they don't like the message that they're not going to do it.
Why do you think that is?
Why
Patience for life, maybe?
why do we send young men to war? Because they think they're bulletproof. I mean, um, I just think it's the nature of what you like as a young male. I mean, when I started in finance, Shelley, I believed that I was going to beat the market, and I didn't understand the mountain I had to climb to do it.
Okay.
And I was hoping what this book would do would instill a sense of I don't know, reality before you started the journey. I wish I knew what I knew now when I was 25,
Mm.
and I would have started an entirely different way of trying to beat the market. I mean, there's still people who can beat the market. Look at Jim Simons, and I talk about him in Renaissance Technologies. I mean, unbelievable returns. Now he
Yeah.
didn't start investing till he was in seriousness till he was 40. He had a bit of a dabble before then. He was a mathematics professor.
Yeah.
And Renaissance Technologies, I shouldn't really call it an investor, it's a trader, but highly successful. And he's in his 80s now. So I think he's in his 80s now. I don't know his exact age, but it's probably 40 years ago that he started it. And his returns have been phenomenal. Far too high to be just chance, just luck.
Yep. And consistent, as you say in the
And
book.
consistent. So I believe alpha is still achievable, but I think people grossly underestimate how difficult it is and the effort it takes. And how you gain that edge is changing all the time. And you don't learn how to get an edge from reading a book.
Mm.
You've got to be unique. You've got to do something that other people aren't doing.
There's an
Not the
element of
same.
creativity.
Yeah, not what everyone else is doing, and certainly not what Ben Graham told us to do back in 1934. What reading Ben Graham today does is makes you safe. It gets rid of it. It's common sense. It's great sense what he wrote,
Okay.
but it won't give you an edge.
Okay.
It won't give you an edge.
I think I was hearing a little bit of overconfidence maybe in some of these young gentlemen that are looking to find the secret
They
or believe
expect
they have the secret
100% returns.
per annum.
I mean, seriously. They do. You know why? Because they luck out. I mean,
Uh-huh.
you remember in March 2020, the
Yep.
stock market dropped about 40% and then sort of regained it. You blinked, it was all over. Remember Robinhood? They're all jumping in and they're all trading and they're all making heaps of money and they're all got very excited. Now, if this is the first time you start investing,
Yeah.
if you can call it that, I used the word investing in
Yeah.
inverted commas. If that's when you start, you think that everyone else is a fuddy-duddy, and I've sort of unlocked the key to the golden goose, and they all get undone. They all get but they don't want to hear from an old bloke like me. They go, that bloke, he doesn't know what he's talking about. He's one of the old dinosaurs as well. But they
Uh,
learn. They learn. They
yeah.
learn.
Their loss.
Yeah.
Sort of, I guess, somewhat related to passive investing. I'm interested in your thoughts on, the green investing wave that we've seen lately. This responsible or ethical investing. Um, how do you think that fits in with your framework?
There's a lot of marketing going on there, isn't there? I mean, I hate to be a cynic, but where there's a demand, there's a market,
Yeah,
created.
it does feel a little bit like that.
I
Yeah.
wonder how green and how ethical some of these things are that they throw into these portfolios. I don't think we're going to change the world by changing our investing patterns per se. I've got to be careful saying these things, but a lot of these people who invest in these funds jump in aeroplanes and use a lot of electricity and drive
Mm,
carbon
yeah, I mean,
creating cars, and you can be ethical one way, but there's a lot of things they don't give up. I think it's a far bigger problem. Far bigger problem. Yeah.
absolutely. I think consumption is such an important part of if you want to make a change.
Mm,
That's what's going to drive investment returns. That's also what's going to drive changes.
mm.
So, yeah,
I don't think there's enough green and ethical investments for everyone to own.
yeah.
God, I'm going to get shot down for saying these things, aren't I? I'm
No.
just trying to be realistic.
All right. So I actually
I'd
wanted to.
like to. I'd like having said that, Shelley. I'd like to think that all corporates are sort of getting more green and more ethical. All of them.
Yeah, I do. I would
And I
agree
think it
that.
makes good business sense for them to do that. So yeah, maybe I'm being a bit unfair. Maybe if these sort of funds become very, very popular, then it'll make all corporates think perhaps that they should be behaving that way. So yeah, I'll certainly concede that one.
Yeah, that's definitely an interesting perspective. Um, right. So actually there was one more question I wanted to ask you about market timing. So circling back to that, if that's okay.
Sure.
Um, what are some of the tools that people can use, or maybe put it another way, if someone comes to you and they have a career outside of investing, and it's just investing is just something that they're interested in, and they enjoy participating, but they're not spending a whole lot of time on it, and they're dead set on market timing. What are some of the things that you would say to them to try and could maybe move them a little bit away from their certainty that they can time markets?
The problem with this is I hear on the media from people who claim to be able to do it. There's one in particular, I'm not going to name him. But he made a comment. He said, if we're not here to market time, then what are we here for? And I got upset when I heard that, because I know he can't market time. You just look at his fund's performance. And I also remember at the bottom of the GFC in late 2008, early 2009, him on TV telling us that people shouldn't enter the market. It was the perfect time to enter the market. So I guess I would like to point to the people who devote their lives to a career investing being incapable of doing it. And I'm not just singling out one person. I've yet to see someone who consistently do it. I have yet to hear from someone who can consistently do it. So I'm going to say to that person who knows little about investing, if they don't know, what chance have you got of knowing? And if you luck it once, then that's what's happened. I think as investors we should react to opportunity that's presented to us, not try and second guess what is going to happen, because we can really get ourselves seriously unstuck. It's a difficult message to tell people who haven't been in the market before, because they believe it's possible. I mean, I talk in the book about in the wake of the 87 crash. And I talk about Bob Shiller, who is probably well known to investment types. He wrote the book Irrational Exuberance. Now, you may remember that in October 1987, the US market crashed 23% one day, biggest percent fall ever on the stock market in the US. And we followed the next day, crashed 25%. Bob Shiller sent out a survey to many investment people working in the investment industry. Basically said, why'd you sell? Fair question. Market's fallen 23%. Why did you sell? In other words, what was the thing that made you sell? You'd think it'd be pretty obvious why a market, there'd be an obvious cause to a market falling 23%. And nearly all the answers came back to Shiller. We sold just because the market was falling. They didn't know it was going to happen. They had no idea. And in the wake of the US stock market, in the 4 months in the wake of the US stock market fall in October 87, they had 6 independent inquiries in the US as to what caused the fall. And they weren't in agreement with each other. So if you don't know post the event that it was going to, that what the reason was, then how are you going to pick it before the event? I mean,
sounds pretty odd, definitely.
But you will have people. I remember in the wake of the 87 crash, there were people who said, "Oh, it fell because," and I knew that was going to. They didn't know it was going to happen. This is just ridiculous. But I tell you what, in the wake of the crash, what an opportunity to buy. And I can remember at the time I was working at Bankers Trust. And I remember walking into the analyst area and speaking with one of the most experienced analysts there at the time. And I said to him, what should I be buying? I remember I was very excited after the 87 crash, and I was only 29 at the time. And I didn't have a lot of experience in the financial markets, but I got excited in the crash. And I always get excited in the wake of crashes. Always. I think they're wonderful buying opportunities. Trouble is they don't come along often.
So talk to me a little bit about how you would distinguish between market timing and opportunism, and how do you actually implement that in a portfolio? Because I think a part of what you mentioned about market timing is that it's sort of like you're trying to guess when there's going to be a sell-off and maybe liquidate or go to cash into some of your portfolios. So
I don't try. No, I tend to come into market crashes close to fully invested because I don't know they're about to happen. So I don't try and pick when they're going to happen. I don't try and pick the time that the market's going to crash, because you can go broke waiting for it to crash.
Or
I
lose
mean,
a
the
lot of
market's going to have
upside.
huge run-ups before they crash. So no, I try and keep 10% in cash.
Okay.
To take opportunity when it falls. But to me, it's far more obvious after a crash that it's a good buying opportunity than before a crash it's a good selling opportunity. I just don't seem to be able to pick crashes.
Sure.
And I can't pick the bottoms.
That was my next question. I was
Don't
just
get
going
me
to
wrong. I
say.
don't know, oh, this is the bottom, so buy. I just say to myself, this is a great buying opportunity. And if it falls a bit more, that's stiff. That's too bad.
Okay, so you might deploy the 10% when you think it's the right time, or you
Yeah, and
might say,
I feel good about it. I mean,
okay,
I feel really, when you can buy bank stocks on a dividend yield of 10% plus, which is what I did in March 2009. That happened actually very close to the
that
bottom.
sounds like it was very close.
Yeah, it was. That was luck.
Okay.
So I don't try and pick the bottom, and no one can pick the bottom except by luck.
But I think in the book you talk about how in these things it's inevitably a combination of skill and luck, or having a strategy in place that helps you be in a position to potentially luck on that bottom, if that makes sense.
I think it's very much a state of mind. You have to be Socratic. You have to think yourself. The market bottom is one of the most pessimistic times in the market. People are screaming out that you shouldn't be buying.
Yeah.
So you have to think Socratically. You have to not be part of the crowd. I can remember in .com, people were telling me I'm stupid not investing in .com. I remember sitting at a table at we call it Buxton, I suppose. We just all went out for dinner.
Yep.
I like the civilized ones. But I remember the bloke on the other side of the table telling me I was an idiot not investing in .com. And he was invested to the eyeballs. Now, I found out later he lost $11 million in .com. So, he never rang me up and said, you were right. But, so yeah, I just think Socratically, try not to do anything stupid. And when the market crashes, don't listen to the so-called experts, I employ something I call mean reversion. It's not my idea. There's a lot of people who use it. You like to know what the market typically should be, because most of the time the market is pretty much tracking on, not doing anything particularly extraordinary. But every now and again, every number of years or so, the market starts doing something stupid. It's doing something stupid because most people are doing stupid things at the time. But if you understand what typically should happen in terms of the mean, the average, and it's way out of whack, that's the time to act.
Okay, so when it's hitting those extremes, that's when you
Extremes.
sort of,
That's the extremes.
yeah.
I tend to be, as I said, I tend to remain fully invested all the time. The only time I deploy, like emptying my bank accounts, I'd mortgage the cat, the dog, sell the house, sell my car. The time I have absolutely zero cash is in the wake of a crash. So that only happens, it's only happened a few times in my lifetime, my investing lifetime, I should say.
All right. Okay. You touched on the media a little bit in there, and definitely in your book. There's so much noise there and a lot of concerns around forecasting.
Gets back to the Dunning-Kruger effect, I suppose. Who are the most confident people?
Yeah.
The people who are on the media, and that's why they're on the media, isn't it?
Yes.
Because they're delivering a very confident. People love confidence, don't they? It's going to be so convincing.
Very attracted to it as humans, aren't we?
But often it's the blind leading the less well-informed, the uninformed leading those people who don't know. We listen to people who are confident. We really do. And they are the people who present a front of an institution, or the people at the TV stations pursue. I think I seem to remember mentioning in the book that I had the opportunity to present my ideas on TV, and I declined because it would be rather about, Michael, and where's the market heading? Oh, I don't know. Oh, all right, okay. No, you got to tell them. You got to know. So sometimes we like to believe things on TV. I often say, and I present quite a bit, and I often say that when someone is on TV delivering a forecast, like an economist, I say use the time constructively. Get up from the couch, go into the kitchen, and make yourself a cup of tea.
Is there a place in the media for a different kind of conversation around investing? Because
I don't think so, because people would find it boring.
right, okay.
No, people want to be told.
All right,
So
okay.
I
That's
don't think there
disappointing.
is a place.
I was hopeful.
I don't think I think the viewer ratings would drop off.
Yeah, okay.
What's happening with the currency? Oh, I don't know. Does anyone know?
So really, we can maybe potentially start to think of it a little bit like entertainment more than
Yeah,
anything else.
I do. I do. I know most people don't. And look, you can tell people these things. I've got a mate who's really, really smart in terms of money and all these sorts of things. Very, very knowledgeable. And he knows all this stuff. He knows that, most of it is just shouldn't be listened to. But every now and again, he'll ring me up and he goes, "Look, I heard a bloke on TV talking the other day about where the economy is heading." And I say, "No, don't, please." We hear this, but the next thing is we prick up our ears and listen to people making forecasts about things, don't we? So it's innate in us.
Yeah.
We've got to fill this void of lack of
Yeah.
knowledge. It scares us not to know, as Alfred Cowling said.
Yeah.
You've got to fight that. I fight it all the time. I think I'm so good at fighting it now. I do get amused when I hear things, and I don't think you need to know these things, Shelley. I don't think you need all these forecasts to be a good investor.
Yeah, definitely. It's not something I thought about before reading your book, but once
Good.
I read it, I realized I strongly agree with you on it. So, it was really eye-opening. I really enjoyed that.
Although it upsets some people. See, I told you, women are intelligent people when it comes to investing. As I said, I get pushback on. I have had pushback from this.
I can imagine that. And I guess to some degree it comes to what you're saying about wanting to have that void filled is, because in a sense, some of it is sort of get comfortable with not knowing, but there's still a strategy that you can implement.
Well, the thing, Shelley, is investing is all about the future. So people say, well, we have to know about the future then. We have to. I'm putting money out there that I'm expecting a return in. It's not about the past, it's about the future. So isn't it judgments about the future? I always say investing is a leap of faith. You have to have faith in the future about what is going to happen in the future. We don't, and that's different from knowing about the future.
Yeah, definitely. Yeah,
Just
that's a
just
really
sit
interesting
just sit and
differentiation.
listen to Warren Buffett talking about this at his AGMs.
Mhm.
Now, one of the greatest investors of our lifetime, and he doesn't believe all this stuff. He doesn't make forecasts. He doesn't believe in forecasts. I mean, I remember him saying that if Ben Bernanke, who was the head of the Fed at the time, whispered in his ear where interest rates are heading, it wouldn't change one thing he was doing with his investing. So we don't need to know these things. As I said, it's not about knowing what's going to happen in the future. It's about discipline, consistency, and patience, and they are human traits, not intellectual ones.
Mm. And ones that I suppose we can build like muscles, maybe to a different extent for other people, from one to another, but
By
certainly.
appreciating what we are incapable of achieving as investors, and that's what my book is about.
Yeah.
Just wiping the idle pursuits that are not going to add to your portfolio or your capability and focusing on the things that do. This is all very boring for young males. Discipline, consistency,
Yeah.
patience, saving. People don't want to save money, but you have to save to invest.
Mhm.
But they want to borrow to invest, whether it be through margin lending or borrowing money from the bank or from friends or using leveraged investments, CFDs, options, futures, leveraging it up. That all works well on the way up, but it doesn't work too well on the way down. And that's why I feel comfortable being fully invested into a crash, because all my investments are funded with my own money.
Mm.
And then you don't care. You just don't care.
Yeah.
Mm.
On the topic of caring, I wanted to round out our discussion and get your thoughts on superannuation in Australia and the level of engagement that we see from Australians, obviously at a high level with their super.
Yep.
Certainly my experience,
Bit of apathy.
anecdotally.
Bit of
Yeah,
apathy.
yeah. So, I mean, what can we do about that?
Gee, that's the hardest
That's a
question
million
you've
dollar
asked.
question. Yeah.
That is the hardest question you've asked. Well, I know what Scott Pape's been trying to do. He's been trying to get it taught at schools.
Hmm.
One of the
Is it taught at
greatest,
schools at the moment?
not really,
Oh.
not really. A lot more useful in Latin, and which I learned at school. You know,
I don't know how you know finance, budgeting, investment hasn't been taught for the last thousands of years.
the problem is, I think a lot of non-investment people see it as a dirty subject. You can't talk about money.
No.
It's really, really a crazy cultural thing to think about when it is such an important aspect of our lives. I mean, and that really is coming home at the moment. I mean, the press are preying on
Yeah.
writing stories about people who are in financial difficulty at the moment. It's become the common theme since, they started cranking up interest rates, over a year ago, May last year. It's become a topic. These people are in trouble. What are they going to do? What are they going to do? Well, I don't want to be harsh, but if we had better financial education at school and it wasn't considered a dirty topic to talk
Mm,
about money,
mm,
then because it all boils down to common sense. I can remember Shelley at age 11 being taught by my teacher in grade 6 about compounding. Now, I didn't relate it to finance at the time, but boy, if more people understood about compounding, and very few people do, just the basic principle of compounding, how much can that improve your life? I remember at age 30 sitting down in my study and opening up a spreadsheet on Excel and working out if I saved a certain amount, what I could achieve through life. And it was mind blowing, absolutely life changing when you make a realization of what you can achieve just spending less than you earn, saving the difference, and investing. As Charlie Munger said, it's a no brainer. There's nothing, you don't have to be a financial guru to do this sort of stuff. And I think people need to understand the different rates of return that are achieved by investing in different asset classes. And the stock market is not risky as long as you are broadly diversified. And the returns that the stock market delivers, 7% compounded after inflation, can be extraordinarily good returns as long as
mm.
they're let run.
Yeah, the long time frame, of course, is
Long
important.
time frame, look at the compounding formula, the numbers are raised to the power time.
Hmm.
You get this exponential curve going on, and these are terms that people need to understand when they are young adults.
Absolutely.
Um,
As you said, it has the power to improve your life so much, which is why
yes,
I don't
yes.
understand why it's not being taught in schools.
But
So I mean, it's
this is
so
this is
fundamental.
this is the point. Money's not a dirty topic. It's how money is used.
Mm.
Um, it's not money is evil. It's the love of money that's evil. It's how people react to it. It's not about it. Buying Lamborghinis and Learjets and yachts, and it's not about that. It's about how it can avoid the problems in life that so many in our society are currently experiencing. Richest
Yeah.
nation in the world, and we've got people who are stressed about money.
Mm.
It's behaviour around money that has got them there. It's
Yeah.
education,
Lack of. Yeah,
lack
absolutely.
of. Yeah. So we have to go back that far. Your initial question was about superannuation and apathy. I I find I found many young people who are in the wrong asset classes in their superannuation.
Mm. Yeah.
And a lot of it's about how these things are listed. You know, uh, shares should form the main part of young people's superannuation because it delivers such great returns over the long run.
Mhm.
But they are classed as risky.
Yeah.
And everyone goes, oh, I'll have the balanced. Well, the balanced may be performing assets that perform terribly over the long term. So that's another thing we've got to work on.
Mm.
And a lot of this gets back to academics as well. I remember 1952, Harry Markowitz, who was struggling with a university paper, came up with a concept for risk in relation to shares, and he
Mm.
related it to volatility.
Yeah, that's a shocker.
What has that done to slow down people or deny people's understanding of the stock market, that risk is equated to volatility? Volatility is bilateral. It's things go up and things go down, and it doesn't have to be lasting either. Price volatility. True risk in the stock market is down. It is a permanent loss of capital. And
Mm.
that's got nothing to do with volatility. So why is the stock market considered risky? You can risk your capital if you are a short-term investor. And I wouldn't actually call you an investor. Months or a year, I wouldn't throw my money in the stock market. But over 10, 20, 30 years, there is no compounding machine like it. And that's not risk. The risk is being in cash.
Yeah.
That's delivering less than a rate of return less than inflation, particularly after tax. There's the risky investment for you.
That's
But over
fantastic.
the short term, months or a year, it's not a risk. So education, Shelley, education.
All right. That's incredible. Think that's a really great place to end, Michael, unless there's anything else you'd like to add. Um,
No?
yeah, I'd love to open it up to you to where listeners can hear and read more from you.
Um, I've written 3 books that are still all in print. The first one, 2010, Creating Real Wealth. The Ulysses Contract only came out this year. It's onto its 3rd print run already.
Congratulations.
So it's done very, very well. But do I have a business that people can tap into? No, I'm not a financial advisor. Uh, Podcasts, yeah, I guess Spotify.
Okay.
I've done a lot of podcasts, but no. Uncommon Sense was my second book, by the way,
Okay.
2015. That is a book that is probably of interest to people who genuinely want to understand the concepts of valuation. There's a lot of history in it, the history of valuation.
Mhm.
Uh, the first book was more philosophical about money, and the Ulysses Contract is sort of a mix of all of them, but I don't get into valuation. It's I got a little bit criticised from some of my friends with the second book. I really wanted to read your book, Michael, but geez, after the 5th chapter, I sort of sunk a bit.
I'm sorry to hear that. That's
Yeah,
disappointing.
yeah. It got into valuation, and not everyone's interested in mathematics. Um, this book, The Ulysses Contract, can sort of be read by anybody. I've had I got a lovely email from a guy who's been in the industry 25 years, finance industry, and he said it challenged some of my beliefs. So anyone. And a beginner, someone who's new to I'd love young people new to the market to read it, as long as they don't get aggressive with me on social media.
All right. We'll send that message out too.
Okay,
Well, Michael, I'd just really like to say thank you so much for your time. I've
that's
really
okay.
enjoyed this episode, and I think lots of people get a lot of insight from the episode and the book. Can't recommend highly enough for people to read it. The Ulysses Contract by Michael Kemp.
Thanks a lot,
Um,
Shelley.
so before I say goodbye for today, if you have any feedback for me about this episode or ideas for future podcast topics, please let me know in the YouTube comment section, or you can send me an email at contact@nucleuswealth.com. And finally, if you know someone who'd get something out of today's episode, maybe a friend, a colleague, a family member, please let them know and help our show grow. So thanks again for myself and the team. We look forward to catching you at the next one.